All righty. Good morning, everybody. Happy Monday. Happy Monday of February. Hey, we made it to February, guys. February 2nd. It is 6:30 a.m. my time here in Kansas City. That is Central Standard Time. 1 hour behind New York City, behind Eastern Standard Time. And it is, let's see here. Give me 1 second. Just want to get my goodies on my screens over here. And yeah, I think we're ready to roll. So February, guys, we've made it through a month. So we are in a new month of new fun things to do, new trades, new opportunities. If you made it through January alive, congratulations. If you made it through January green, congratulations. Green in trading on your account, your balance. If not, guess what? We got another month. There's always another month. Okay, if we have a good month, great. If we have a bad month, great. What do I mean, great? Well, if we have a bad month, that just means you lost some trades. But the best part about that is there's lessons to be learned out of all these trades that we win or lose, especially the ones we lose. All right. Losing sucks. Losing is hard. Right. But I'm telling you, it's your best teacher. Anybody that's on here trading, streaming, if they haven't blown an account, I don't want to hear from them. Okay. I'm one of those statistics from a past life, blowing accounts. And that's a good thing. Okay. It's easy to teach what you've done. So, since I've blown accounts in my distant past, that should hopefully give you guys a little comfort in knowing that, hey, I'm here teaching from experience and not just from theory, not just from, something I read in a book one time. Good morning, Thado. Good morning. Good morning. So yeah, that's all. That's the goal with this. The goal with this is just to help teach. Just with any mentor, any teacher, okay, you got to learn from experience. And when you get that experience, you gain that experience, it makes it a lot simpler to teach, teach, coach, share, spread, whatever the case is. So we're at it for February. Okay, February just obviously means we can change the sentiments, especially when it comes with, how good or bad an asset performs in a specific month. So let's get my charts up here and we'll take a look. I am in a trade, by the way. I'm in a trade on the Aussie dollar long pair. But as with any new change in month, there comes a new seasonality. If we're taking a look at our top setups here, there's a new seasonality score with everything. Okay, whether or not something on average in the last 10 years does good in the month now of February. So obviously last month, these candles were different for some assets, but now that we're in February, we want to know on seasonality what does good or bad or neutral in the month of February. So this top setups will now show the scoring for the month, the new month for seasonality. What about the COT report, guys? Let's go take a look at the COT report just to get a overall feel for what the big banks and institutions and hedge funds, basically the smart money, where they kind of positioned themselves last week. As always, this COT report is accurate as of Tuesday. So this report was refreshed on Friday, just the other day, at around 4 o'clock, 4:30 my time, Central Standard Time. So around 5:30 New York time. But this report, when it's released every single Friday, is always accurate as of 3 days prior, so Tuesday, okay? So what this is showing us, if I just kind of scroll down my list here, number one, up here is the overall, the long-term positioning, okay? Think of a bank doing a position trade, a trade that they're in for several weeks, several months even, okay? Or perhaps the whole year, just a long-term. This is not the 5 and 15-minute traders up here as the point. Okay, this is long-term wealth creation up here. So just by looking at this, what's at the top? It's gold and silver. Okay, this shows over here that just as an example, gold, big banks and institutions, okay, the ones that are making money for everybody else and themselves, of course. Okay, they're the most long gold at 84% and silver at 68%, despite the big sell-off we had on Friday. Okay, and then the early part of this session. Okay, we've had another drop in gold and silver with a slight rebound, but we'll take a look at that here in a moment. So despite all the heavy selling last week, and despite the fact that gold dropped, what was it, like 10% on Friday, silver was at like 24% on Friday, something like that. They're still overall positioned the longest on the gold and silver compared to any other asset. Now we get down into the weekly results. So in other words, the results from week to week, the net change. And as you can see at the very bottom, well, not the very bottom, but close to the bottom, silver was obviously one of their biggest sellers. They sold silver to the tune of, well, they changed percentage to the tune of 2%. So they did add 510 long positions, but they also added 2,000 short positions. So remember, they're trying to balance things just like everybody else. Okay. So despite it all, though, they did have a 2% sell-off. That's understandable. That's to be expected when you have a big sell-off like that. Xander, good morning. Who else we got in here? iHouse. Let's see. iHouse. Can I just go with iHouse? That's a tough one for me to figure out. iHouse Sainazol. iHouse Sainazol 626. Yeah, that was my best attempt, my friend. My caffeine hasn't quite kicked in. I just woke up a half hour ago or 45 minutes ago. But anyway, guys, gold and silver, man, big drops, gigantic drops. And it kind of shows a little bit in the COT report because silver was 2% of a sell-off. Gold was 0.92%. So gold really, in the grand scheme of things, wasn't that big. I kind of look at this. COT report, and it's just me, but anything within like minus 2% to positive 2%, I just kind of deem that a little bit more on the mass side, neutral side, meaning it didn't really give me a strong enough reason to follow the banks on that particular asset. Now, when we're looking at things like the Nikkei down here, look at that. That was a 15.5% sell-off. So if the banks, if the big banks, if the smart money, the ones that make all the money, if they are selling to the tune of 15%, does this give me a very strong, exciting reason to go out and buy the Nikkei? No, it doesn't. Okay. Now, it's not to say I won't, but this right here is one of the biggest indicators that, hey, the banks, the people that know everything when it comes to these assets, do they know something we don't know? Quite often, yes. That's a silly question. So I don't know that I want to be going out and buying the Nikkei. Now, I don't have a bullish signal anyway on it, but assuming I had a bullish signal on the top setups, that would make me hesitate. Okay, that would make me hesitate. And then the same would be true for, obviously the positive side. Let's take a look up here. What was the biggest winner? Well, it was the Canada dollar at 8%. So the big banks added 17,000 long contracts, meaning that's bullish bets. And also, alongside that, they got rid of 8,000 short positions, okay? So both of those are quite bullish. Obviously, the bullish for adding 17,000 longs, but then it's also bullish that they got rid of 8,000 shorts. 8,000, these are contracts. Okay, contracts in the options market. Okay, that's what this number represents. Now, guys, I have this obviously on the Edge Finder from A1 Trader, but you can always go, if you want to look at this, you can always go to barchart.com and look for the non-commercial COT changes, COT report. Okay, you would want to look for what's called the legacy report. In fact, I guess I can just go ahead and let's just go ahead and take a quick look at that. See if I can still remember where it's at. So this is barchart.com, guys. This is a gigantic report to follow if you're a currency trader. Okay. Or any trader of anything. Okay. I mean, futures trader, currency futures even. I mean, this thing has everything. But this is a great place to kind of follow the big banks. Remember, the whole point in trading, as far as I'm concerned, is observing the big banks and hop on. Okay. Ride their coattails. Do what they're doing. Okay. So anyway, yeah, you can go on here, and I do believe you go to currencies. Let's see here. I believe it's so commitment of traders right here, and then you go legacy report. Can right here, and you want to change this to non-commercials because we only care about the large speculators. We don't want to look at the hedging report because the hedging report typically does the opposite. But here you go. Okay. This is going to be showing you all your currency here. And this will show you week to week changes. If it's green, that means they added more longs, net longs. If it's red, that means they added more net shorts, meaning bearish bets for all your favorite currencies on here. Detailed report as well. So barchart.com, okay, FX, COT reports, non-commercial. If you guys ever want to follow this stuff on your own, I would highly recommend you do it. Okay. Now, if you ever, and if you ever want to make a small one-time investment, then what you would really want to do is go over here and get the Edge Finder. Okay. As always, you guys can find this here at a1trading.com. Right here, Edge Finder. Okay. Just anytime you guys want to check this out, it's a one-time payment, and then you don't have to pay for anything monthly. It's just a one-time payment, and that's it. Any upgrades, updates that comes on this thing, which is quite regular, okay, you get those for free. So just want to point that out there. I'm not affiliated with them. I don't make money from sharing this info, or, if I were to bring another sale or something to them, I don't make money from it. So it's not, that's not the whole reason I want to show this. It's because I strongly believe in this thing. People pay like $2,000 a month, $25,000 a year for the Bloomberg terminal, right? The big banks, the big boys on Wall Street. So this is something I think is just as good, if not better, because it's a lot simpler and it's a tiny fraction of the price that you pay one time. So anyway, that's my little piece on that. I just thought I would do that. I didn't tell them I was going to mention this, but you guys, this single-handedly turned my trading around. That's why I feel so strongly about it. So anyway, let's get back to the COT report just to get a quick synopsis one more time. So number one, Canada dollar. Okay, we already went over that. Increased their longs by 8%, over 8%. The Dow Jones is back. Okay, they added 5.7% to the Dow Jones. They added 2,300 contracts, and then they got rid of 2,000. So that's both bullish reactions, okay, bullish actions. Aussie dollar is the second strongest currency, and it makes sense because Australia dollar is the strongest from a fundamental perspective. Okay, 5.4%. So they added 24,000 contracts. Excuse me. But they also added a tiny fraction of short contracts, but they added an overwhelmingly amount of the long side. So very bullish for the Aussie dollar. That's awesome because, and this is part of the reason I got into my Aussie dollar, US dollar long trade. Okay, because I'm trying to follow the big banks, observe them and follow them, ride their coattails, hitch my wagon to them. Okay? Now, this is not the end all be all because you guys hear me talk all the time about all these other reports. Okay, NFP, which we have coming up on Friday, by the way. Okay, this is the account killer, so remember that. That's coming up Friday. But then, of course, all your other economic data, inflation data, sentiment, which is the big banks right here, COT, and then crowd sentiment, which is the average retail trader at home on their computer. Remember, we want to look at the crowd, the retail crowd, observe the masses, and do the opposite. So just keep in mind that these two reports have an inverse relationship. We want to follow the COT. We want to go against the retail crowd. Okay, that's your sentiment analysis. This is what nobody else on here talks about on YouTube. Okay, see, this is as important, I think, as the fundamentals themselves. Not as important, but it's right there, pretty close. Okay, fundamental analysis, everything over here to the right, that is the most important thing in trading. Right behind it is sentiment analysis. Okay, observing the crowd, observing the banks. And then when it comes to the technical analysis, everything that's glorified on here on YouTube, this is, in my opinion, the least important of all. Okay. And this is what we all get started with in trading. Hey, let's go look at a chart. Hey, what's my golden indicator that'll make me a lot of money? Right. We all do this. We've all done there. We've all been there, done that. So just keep in mind, there's a hierarchy to this stuff. Fundamental number one, sentiment number two, technical number three. Okay. The least important analysis group is what everybody clamors over. Okay. It's not the most important. It is the least important. Because the whole point of a chart is to go and time our entry. But our entries, guys and gals, are made from the fundamental and sentiment analysis. That's where we decide that. Okay, when you really want to start digging deeper into trading and understanding what moves markets, who moves markets, that kind of thing, this is where it all starts. So why pay $2,000 a month on a Bloomberg terminal when you can pay a one-time payment on the Edge Finder here from A1 Trading? And I've been with these guys now. I do streams with them. Again, I don't make a dime from them. Okay? I appear on their streams once in a while, just mainly to try to build this thing up. That's the whole point. So anyway, just my quick little spiel on that. And going back into, we'll just finish out real quick with the COT report, though. But yeah, the currency's got a pretty decent boost as a whole. There's your Canada dollar, your Aussie, your US dollar, the euro at 2% gain, the pound, okay, with a sub 2%, pounds, the yen. And then as far as the bearish side, or what the banks sold, okay, basically they sold the New Zealand dollar and the Swiss franc. Swiss franc's not a surprise. Swiss franc, remember, is the worst performing fundamental currency right now. It just is when we're talking about the high impact red folder events. What else we got on here? Bitcoin, pretty modest, 0.6%. That's almost, meh. But as far as indexes go, the indices, again, we got the Dow. They bought the Dow. They bought the NASDAQ. And then the Russell they sold down here at 2.96. Where's S&P at? It's right in front of me. Oh, yeah, S&P is right here. So they sold that too. So they bought two indices, and then they sold two. Okay, so that's kind of a wash. It's not really getting a strong signal either way on, hey, do we want to go long indices or do we want to go short? Well, if they're only buying half of the major ones and selling the other half, that's kind of like a mixed signal, right? So that's kind of the way I look at the COT report. So yeah, that's that. Popping on over here to the top setups. Okay. Now we still got some of these pairs: Aussie Swiss, New Zealand Swiss, Kiwi Yen, Aussie Yen. These are still at the top of the list, but the scores have just slowly dropped. So on Friday, Aussie Swiss, New Zealand Swiss, these were giving us a score of plus 15. Real strong, very bullish score. They still are giving us a very bullish score, but the points have just dropped a little bit. So just a very small decline in strength, but still overall overwhelmingly strong to buy. That whenever you get a high score and then you get a couple 2-3 point pullback in the scoring, well, guess what that means? It potentially means that asset could be retracing in value. And if it's retracing in value, then we want to look for a buy in a demand zone underneath. That's how that works. That's how I do it. That's how I, treat these scores. If I got a really strong score and then it drops a few points, good. That just means it's probably going to drop, hopefully, into a demand zone. And that's exactly what happened. Okay. Getting over here to the Aussie dollar. Let me just get rid of some lines here. Aussie dollar. Okay. I was looking at this 4-hour demand zone now. Now this started off with a daily demand. That's this rectangle over here. I just moved it to get it out of my way. Now we got a 4-hour demand from that candle right there. Okay. Bring that forward. You guys can see we dropped into it. Right. So, but I have a white dash line. Good morning, MD Yusuf Ali. Good morning. But yeah, you guys see I got this white dashed line in the middle. So if I step on down to a 1 hour time frame, okay, you can see where price dropped in. It dropped in right on that red candle right there. See that? That red candle? That was the last down candle, the last basing candle before the strong move up. And that move was pretty strong. Okay, it pushed price quite a ways. So that's exactly where I bought. Guys, I limit ordered in on this thing. I felt so good about it. Aussie dollar, as we can see over here, is giving us a bullish score of a 7. Okay, +7. So there's really only 3 items going against it. And that's the number one, the seasonality. Okay, the seasonality for the last 10 years on average for the month of February, points bearish. GDP points bearish, PPI points bearish. Other than that, you guys see I got a whole bunch more blue boxes on here. The jobs market, the inflation numbers, and the economic strength indicators are pointing bullish. Okay. Trend is obviously up. Crowd sentiment is net short this asset. Okay. This is giving me a bullish reason to buy because the crowd sentiment is going short. They're net short. If they're net short, do I want to do what they do, or do I want to do the observe the masses and do the opposite? Okay. It's unfortunate, but most traders lose money. So this is how you get around losing money yourself, is when you're getting away from the crowd. Break away from the crowd and go out and do things the way it's supposed to be, following the fundamentals and the sentiment. Okay. So anyway, Aussie dollar +7. And you can see over here on my actual chart, my actual broker chart, again, okay, took a buy from this 1 hour demand zone over here. That 1 hour candle right there, that red candle. Everything's compressed a little more on this chart, probably because I got my moving averages. There we go. Okay, 1 hour demand. Now I gave it some wiggle room, quite a bit of wiggle room. Wiggle room. Say that 10 times fast. I can't talk this morning. Let me have another shot of caffeine real quick. Yeah. With the anticipation, guys, of taking this trade to the swing high up here. That's where my take profit's at. Profit target, I should say. There's a difference between a take profit and a profit target. Do you know that? Okay. What's that mean? Well, a take profit just means you set it and forget it. Price goes your direction. As soon as it hits, you just close it out for a trade, right? Take your profit. Profit target just simply means if all else fails and I'm asleep and I'm distracted, or I can't be on my chart. Okay, if I'm not around my computer, I at least want to go ahead and take my profit there. But so long as I'm awake, then I want to be actively managing this trade, because, if price starts coming up, then I want to be, when price starts getting around that area, well, I want to kick the profit target further up and manage it so that I can, start trailing my stop. Because, obviously if we start getting price do something like this where it breaks through, well, by then I'm going to be having my stop loss moved around. Okay, so here's my stop loss down here currently. Okay, I want to be kicking it out underneath some of these swing low points. Swing low there, swing low there. That way, when price comes up here, I can have a chance at taking a longer gain. Now, if you're in a challenge account, a prop challenge, then just keep in mind that a lot of these prop challenges, prop firms, a lot of them have consistency rules. Okay, so you might not want to do this. You want to just take your simple 2-to-1 win or your 3-to-1 win, however you best calculate that. Because if you go for the gigantic wins, it's going to skew your consistency score. Or if you're with a prop firm that has what's called an equity stability score, an ESS, meaning it takes your largest winner and it adds it to your largest loser. And then you take that number, divide it by your total profits at any given time. And just, there's ESS scores that have to be under what's called 20%. Okay. And other prop firms may have different ESS scores, but it basically penalizes you for having one gigantic winner. Okay. It really does. It kind of sucks. I hate that. I hate that rule. I really do. It's like the stupidest thing ever. It's penalizing you for gaining wins, a big trade. Well, and the idea is obviously they don't want somebody being a YOLO trader come in, win one gigantic time, and then screw off the rest of the time or whatever. It just basically wants to see consistent traders. And you want to be a consistent trader, so I get it. But it just sucks when you have a big ass runner that skews your score. And and it doesn't breach an account. It just basically means you got to keep trading and you got to keep increasing your profits to where those scores balance themselves out. So it's annoying. It can cause you to miss payouts and things of that nature. So what I just explained about taking, trying to ride this up, this is really only if you have a cash account, your own money. Okay? Go for the home runs, in other words. But yeah, just keep that in mind, guys. If you don't know what I'm talking about, you might just and if you're in a challenge account, just make sure you go to the website for whatever prop firm you have. Go check out their trading rules that are specific to your specific challenge account, and just see if they have an ESS score. See if they have a consistency score. Most of them at least have a consistency score. Sometimes it's as high as 50%, which is nice. Sometimes there is, especially on instant funding accounts, sometimes they're down around 15%, which is not good. That just means you'd better stay strict at a 2-to-1 or a 3-to-1 and don't let anything run. It sounds counterintuitive, and trust me, I'm right there with you. I hate it. I think it's stupid. If you're an experienced trader, then you want to get those home runs. If you're a newer trader, and when I say new, I mean under 5 years, guys. Okay, that's new. But that's where it makes sense, because they do want you to become consistent. That's the whole point in trading. So anyway, off my soapbox about that. I am in the Aussie dollar long. I'm going to monitor it up here. In fact, I'm going to set an alert on my Aussie dollar trade. Well, I want to set it right here for one, and I'll tell you why. I'm going to set my alert up here. So let's just throw it out through the end of the week, because regardless, I'll probably have this closed out by the end of the week. So here's what I'm going to do, ladies and gents. I am going to set my alert right here, because just ahead of it is a strong supply zone. See that candle right there? Okay. That candle looks like a pretty decently strong supply zone, because you had the couple candles of basing action right there. You had a very strong drop in price that also broke a structure. Now did it close? No, it did not close. So you can see the close was basically at the bottom of this wick over here, these couple wicks. Now it wicked through, so it still is technically a break of structure. If I go to a smaller time frame, there's going to be a close under there. But the most important thing about that supply zone right there is the fact that we had a high spike in volume, a high spike in trading activity. Okay, ultra high volume. This is what's called ultra high volume. When you get a red candle on your RSI, your volume spread analysis, guys. Sorry. Need another caffeine shot. Okay. Ultra high candles in the volume spread analysis means a ton of trading activity compared to the previous candles. Okay. Yellow is higher than average, higher than normal. And then green, as you see on there, is average. Now, if you see a blue candle, that just means well below average. I don't like trading supply and demand zones that are formed with tiny bars. I like supply and demand zones with big ones like this, because that means a very strong institutional drop. And if institutions are creating this supply zone, I want to be careful when and if price returns, especially when I'm buying and hoping that price breaks through that. Because remember, my profit target's up here, remember? But I want to be aware but when price gets in this area. So by the time price gets in this area, then I'm going to have my stop loss moved up, kind of close to it. Okay. Now, obviously, as price comes up, it's going to make new, higher highs and higher lows on a smaller time frame. So I'm going to stay tracked underneath it so that when price gets right here, I still want to leave it some wiggle room, because price very easily could obviously, come up, come up, come up. Now, when it runs in, it could very easily cause this thing to drop. But I would anticipate, because I've got a strong enough demand zone, I would anticipate it would turn around, rebound, and go through it. So, at this point, I want to have my stop loss underneath my swing low. Now, obviously, like I said, if you're just a challenge account, you got a consistency rule, you got a ESS rule you got to meet, just go ahead and, it would probably be better to put your take profit right here in this area as an example. Because our profit target we do have, there's really not a whole lot of volume up here. So I would anticipate it would probably have enough strength to easily chew through it, and keep going like this, right? But especially if you're in Aussie dollar, just be aware you got a strong supply zone over here, real strong, that very easily could take price and bounce it all the way back down like this. Okay? But I'm anticipating that it would be good, and I'll just try to write it through it. Excuse me. So that's Aussie dollar. Nothing for me to do now. I just let it do its thing this week. Yeah, I got 5 whole days for this trade to work itself out. And as always, I'm gonna, I try to have my trades closed by the end of day Friday. I always set an alert on my phone for 3:45 p.m. my time, because I'm sorry, 4:45 my time. 3:45 my time. Jesus Christ. 3:45 my time, so that I can have my trades closed before the 4 o'clock close. 4 o'clock Central Standard Time. 5 o'clock Eastern Standard Time. This is currencies. Okay. The hour after stocks. So stocks close at 3 my time or 4 New York time. Okay. And then currencies close an hour later. So anyway, Aussie dollar's done. Let's take a look at the economic calendar, guys. Let's see what we got this week. Let's go put this on this week. And just kind of a recap of last week, and then we can kind of preview this week as well. Just some of the market movers last week. So remember, we kind of had the easing of the U.S., Greenland, and NATO tensions. So prices did quite a bit of a flip at one point, thinking that Trump could potentially bring the military to Greenland and start shooting things and whatever. Okay, you guys hear all the same news events that I do. But then he kind of put them to ease. Remember when he talked to NATO's leader, one of NATO's leaders, and his name's blanking me off the top of my head. I can't think of his name, but put him to ease. Said, no, we're not going to do that. We're not blowing up. So then they came to an agreement with Greenland as far as, being able to put some things in place for safety and security. So that was good that happened. When that happened, things kind of eased up a little bit. But yeah, just looking over here at my notes, I typed in U.S.-Iran escalations and military posturing. So yeah, just keep in mind, we still got that. I do know that the military did send, I think, three aircraft carriers over there. And I know they've already got one in the, kind of on the other side of the Strait of Hormuz, kind of by, my goodness, Bahrain. So I think they're up to like 4 aircraft carriers over there. It's crazy. Not to mention all the other ships that kind of escort it. So they're quite positioned over there for any potential conflicts. So that's obviously got people on edge. Keep an eye on oil prices, especially if any shots get fired. Okay? Oil has a tendency of flying up when that happens. So just keep that in mind. That's the U.S.-Iran escalations. Obviously, the tariff threats, and of course that came as part of that U.S.-Greenland NATO tension, right? The 10 to 25% tariff threat, which of course got kind of pulled back. So we're good on that. But yeah, that was the beginning of last week, right? And obviously the Venezuela regime change, the aftermath of that. President Trump, by all accounts, sounds like they're having a decent relationship with the lady president over there, to where she's at least kind of fallen in line. So it's kind of interesting to follow that relationship as well. We dropped in and took their dictator, and I won't say president because he didn't legally get elected, right? You guys know that. If you don't, now you know. He did not win the majority when he got president. Talk about Maduro. So it's a dictator. He didn't leave office like he was supposed to. That's just a fact. He did not win the votes. He didn't win the votes. So I ain't going to call him president. I'm just going to call him dictator. So, but anyway, yeah, by all accounts, it sounds like the replacement is at least abiding by the rules of the U.S. Which is going to be interesting to watch, especially in the months and years to come. Okay. So yeah, enough about that. And then, guys, we do have the government shutdown nonsense kind of up in the air again. Okay. It's so ridiculous. It is ridiculous that you can't get two sides to come together to talk things out without going through all these threats and shutdowns and nonsense, making people suffer. So that'll always have markets up in arms whenever you've got that instability. Because if there's one thing markets hate, it's uncertainty. Markets cannot stand uncertainty. Now, we got a little bit of uncertainty with obviously the nomination from President Trump for the new Fed chair, Kevin Warsh. So that definitely eased some tensions. That definitely gave some clarity. You kind of had a little bit of a dollar. Let's get this reset. A little bit of a dollar rebound on Friday as a result of it. Talking about this green candle over here. So that was kind of a result of the Kevin Warsh mention, okay, by the president. The markets liked it for the dollar. Okay, he's dovish, but it sounds like he may be quite independent, which I think everybody should like. Okay, the Fed should be independent, but anyway, the markets clearly liked it. That we had that green candle right there. Okay, just getting back to and then as far as this week goes, let me see, guys. We'll go through the economic calendar here in just a second. Yeah, so just keep that in mind. I mean, things that could potentially move the markets. Again, it's pretty much the same. U.S.-Iran tensions. There's also a treaty expiration on Thursday. New start, nuclear treaty expiration. Okay, that's the last major U.S.-Russia arms control agreement that was signed, and it expires on Thursday. So they're going to have to figure out if they want to renew that or shit can it or whatever the case is. Removes legal limits on strategic nuclear forces, potentially heightening global security risks and volatility. So that's obviously going to cause people that know some history, to be a little bit on edge. Hey, do we want to go back in there and make sure that we don't do anything stupid as a world? Not just a country, but as a world? Do we want to put those, checks and balances in? Potential increased safe haven flows, gold, treasuries, U.S. dollar pressure if perceived as eroding U.S. language. So as long as we're talking, guys, to our enemies or I don't want to say enemies, but, people that we don't like so much, let's put it that way. As long as we're talking, that's a good thing. If we're not talking, that's a bad thing. Keep the dialogue going. This is my PSA to all these countries. Keep the dialogue flowing, because if we're talking, that's a lot better than not talking, guys. But that's that nuclear treaty expiration. The whole point is the arms race. Okay, is this going to send us back to the Cold War era and even before, to where people are racing to create this weapon or that weapon? So this is kind of a checks and balance on that. And obviously with the Russia-Ukraine situation, that's important. Okay, get the dialogue flowing again. Get something new signed. Obviously, you got ongoing fallout from Greenland, the NATO Arctic framework, and tariff threats. So, it's not quite over yet. He did kind of pause the 10 to 25% tariff, threats on the backs of that agreement, which I don't think we really know all the details about. But he sounded pretty happy, President Trump did, from it. So we'll see how that all turns out. Yeah, and then Russia-Ukraine dynamics. So that's basically kind of some ongoing geopolitical stuff just to be aware of. Yeah, that's that. That's the geopolitics of the moment. And then speaking of the economic calendar, here we go, guys. What have we got today? Well, in about an hour and 49 minutes, we do have the U.S. dollars manufacturing PMI report released. Now that number, guys, is still, this number up here is still in contractionary territory. Okay, contractionary. It's contractionary because it's under 50. 50 is the baseline. If we're under 50, we're contractionary. If we're over 50, we're expansionary for the manufacturing sector. Okay? So the previous is 47.9. The forecast is to grow by 0.6, which is still contractionary, but it is a bullish sign if that were to take place. If we get anything over 48.5, right? So if we get 48.5, then that just simply means they meet expectations. But if we get 48.6 or higher, that's an exceeds expectations. That'll give us a green box here. And then the PMI data box on the US dollar will get bullish. Okay, so that is, in fact, I'm curious to see what their, let's see here, guys. Where is my economic data? I want to go inflation data. Oh, I forgot the PMI report's not on there. Well, anyway, so yeah, that'll come up here in just less than 2 hours. Tonight we have Australia's cash rate release and statement coming out. So that's 9:30 my time. I'll still be awake. I'll damn sure be awake because I'm in an Aussie dollar long position. Okay. So if I'm up pretty decent, actually, I don't know. I may be out of it by then. I may quite possibly be out of this trade by then. If not, I'll be choking the hell out of it with the stop loss. Now, if let's just put it this way, guys, you see my stop loss down here, right? If price just continues to dance around today like this, I'm probably likely going to be out of the trade, right? If it stays right there by this evening, probably going to be out of the trade. Because at this point, if I've got a bullish, or if I've got a small profit like I do right now, $300, why do I want to waste the $300 and then turn around and lose $500 in the case of this account? Because that's my 0.2%. Why do I want to throw away basically $800 if this thing goes against me in 2 seconds? Right? If it's a miss, if the report is a miss. I don't want that. So I'm probably just going to go ahead and at least pull to break even. If not, just choke the hell out of it with some of these unrealized profits. Because remember, I want to cover my potential spread costs because the US dollar does have a higher interest rate than the Aussie dollar. So since I'm buying the Australia dollar, I would be paying a swap fee. If price, regardless of how it closes out. Because I did get into the trade last night. So we're now on a second day, right? So I'd be paying a day of swaps. How do I know that? Well, because I've got a carry trade scanner somewhere down here. Let's find it. They moved all this stuff around again, guys. So I just got to go find it. Where did they put the carry trade scanner? There it is right here. Okay. Here's our carry trade scanner. Where's the Aussie US dollar? Let's go find it. Right here, Aussie US dollar. Okay, that's my trade. Remember, I'm long. So the Aussie dollar pays 3.6%. That's their rate. Okay, the US dollar, remember, we're at 3.75%. So if you take 3.6 minus 3.75, that's minus it's minus 0.15, but because I bought this asset, it's plus 0.15% that I would have to pay. Now that's not that much because there's really not a big difference between the Aussie and US dollar, currency rate. So that's really negligible, but especially if you're, matching together some of these other currencies, if you're short pound Swiss as an example, well, you're having to pay a 3.75% on your position just for being in the trade. And that's each day. So I'm really not that worried about it. It's going to be a negligible swap fee to begin with. But yeah, you guys carry trade. This is something that's more advanced. It's not anything you got to really truly worry about right away if you're newer. But there will come a point in time if you stick with it. Okay, if you stick with it, you're going to definitely be knowing what a carry trade is. Okay, because this is just a hidden charge, a hidden tax if you're going against the grain on an asset, especially for multiple days. If you're doing this on the intraday session, it's not that big a deal. But if you start turning into holding trades for weeks, months, things like position traders, longer term, even shorter term position traders, right? This thing could really bleed you dry if you're going against the grain, okay, if you're going against it. So, but yeah, the whole idea is if this is blue, you want to be holding those because you'll get paid that swap fee, that swap rate. Pound Swiss, if you're long pound Swiss for a long term, you're getting paid 3.75% on that position. Okay. So it's basically 3.75. So the base currency minus the quote currency. Okay. In this case, it's 3.75 minus 0 because Swiss franc doesn't have one. So, at the moment anyway. So you're getting paid that full swap. That's nice. You want to be long. If you're a position trader and if you got a good economic and fundamental and sentiment reason to be long the pound over the Swiss, because the Swiss, remember, is the lowest currency right now. But if this is the case, you want to be long that because of that swap rate, for one. Now, obviously, the big money is made from, getting the gain, getting the pound Swiss to go up. But it's just a nice little added bonus when you get paid a swap fee as well. So again, that's more, advanced stuff. I wouldn't worry about it too much, guys. But as always, if you ever want a better breakdown of that, just, let me know, or whatever the case is. We can definitely do that. So anyway, just to finish off the calendar. Okay. So yeah, that's Aussie tonight. Okay, rate statement, and then the lip flapping session to follow. Now, Tuesday, we've got a JOLTS job report coming out. Okay, tomorrow at 9 a.m. Central Standard Time. The JOLTS number has been quite, not quite, I should say. It's been negative. It's been down, but, kind of slowly. And a very slowly annoying, like a mosquito bite on your neck or getting bit by a gnat. Okay, it's just annoying. It's not killing you, but it's going to kill you over the long term. So that's been the JOLTS job number. It's just been going down steadily. Very steadily down. Where is my damn data? Macro. God, I got to get quicker at finding this stuff. There we go. Labor data. Yeah, everything. Like I said, guys, everything got moved around, and I still haven't learned where everything left or went yet. JOLTS job openings. That's what I'm trying to find. Good grief. Okay, so just keep in mind, this is your JOLTS numbers. Is that right? Yeah, JOLTS. Okay. Go to 3 years. Okay, so there's your JOLTS job numbers. Okay, very, very steady decline. Almost so quiet you don't even notice it. But when you take a look, just 2-3 years ago, the numbers were up in the tens, 11 and 10 million. okay, per period. Now we're down at 7. So just a very slow downward trend. This is what I meant by, a slow death when it comes to the JOLTS job numbers. But anyway, yeah, the previous number is 7.15. Now they're projected to go up a little bit. Okay, 6,000 more, or no, I'm sorry, 100. Oh my God, my math is not working today. 150. So that'd be 60,000 more. Okay, we're projected to go 60,000 more jobs. So that would potentially be a good number for the JOLTS. That's 9 a.m. tomorrow. And then 3:45 Central Standard Time, PM, okay, post meridian, is New Zealand's employment numbers. Employment change looks like they are projected a 0.3% increase, which would be good for their currency. Unemployment rate looks like it's projected to stay the same. So if all this comes out true, then that could potentially be a slight bump for the New Zealand dollar. And the New Zealand dollar is doing pretty well. Okay, we know that because of the ACO surprise meter. I swear I got to get quicker about finding my data over here, guys. I got to learn this. I'm going to have to force myself to memorize where everything's at. New Zealand, look at this. This is our eco surprise meter. New Zealand and Australia dollars are tied at the very top of the list. They have exceeded expectations on 83% of their high impact events. That's a good thing for their currencies. This is fundamental analysis. This is isolating the fundamental analysis. Okay, so real quick, we just go over here to Australia. Look at their Australian dollar impact. In the last 7 days, that's all these items that you see in the yellow font. That's only items that were released in the last 7 days. So obviously you see there, they did have their inflation reporting come out that came out bullish. Their CPI report, they increased by 0.2% from their forecast. So that is a good thing for their currency, a bad thing for their stock market and their pocketbooks, the citizens of Australia, okay, our friends from down under. Inflation, higher inflation, regardless of what country you're in, just means that you're paying more for the stuff that you have to pay for. But then you flip it over to their PPI, and they actually nailed that expectation on the dot. So we got a neutral reading out of that. Remember, when you get these neutral readings like this, you basically take it out of the equation for this number down here. So basically, this number is calculated from adding together the blue boxes. In other words, the bullish boxes, which in this case we had 5, and then divide that 5 by the total amount of either bullish or bearish. So in this case, we got 1 bearish. That means we've got 6. So 5 divided by 6 is 83%. And that's how we come up with that figure right there. And as you can see, roughly 55, 60% is where the bullish impact starts. And then down here, it would be about 40% basically. 40% or lower is how you get the bearish number. So Aussie dollar looking great. New Zealand dollar, exact same thing, guys. 5 out of 6. No reports last week. In fact, the last report we had from them was, let's see here, January 15th. Yeah, so that's when they had a manufacturing PMI data that came out bullish. And that was a big one too, because their previous number was 51.4, which was already pretty good and expansionary. But then they come up with this gigantic number, this big increase up to 56.1, guys. That's great for New Zealand. That's pretty damn good. Okay. For the industry there, for the manufacturers of the Kiwi. So there's your 2 strongest currencies. And then just going back over here to our index, remember, we got the Swiss franc that's still slugging away in the mud over here. It's not exceeding anything. Okay. Swiss franc right here. Look at that. Zeros. You had one neutral report where they did meet the forecast of the inflation number, the CPI number. But other than that, everything else has been a miss. Their manufacturing sector is in contractionary territory as well. So it's just not looking the greatest. The unemployment rate's not horrible over there, 3.1%, but it was still an increase from the previous number. Inflation, pretty decent, okay, 0.1%, not bad at all. But everything else has been missing. So Swiss franc is your number one, is your weakest currency from a high impact fundamental standpoint. And US dollar staying steady right there, pretty neutral. Okay, 55%. Remember, the 60 or higher number is bullish, 40 or less is bearish. So dollar just kind of hanging out there in neutral territory. Same thing with Canada. They're quite neutral as well. Just need another good report or so, and then Canada will be back into the bullish list. Japan straight up 50%. Okay, you don't really get the greatest signals from a fundamental perspective when you've got scores in the 50s, scores in the high 40s, things of that nature. But then Euro is doing pretty well. They're doing pretty good as well. Okay, they got 71%. British pounds hanging out. They're in bullish. It's not a strong bullish signal, but it is bullish nevertheless at 67%. And then Canada neutral as well. So that's your currencies over here on the far right. You kind of see them in order of strong versus strongest versus weakest. So there's your Swissy at the very bottom. And then your strongest is here. So overall, guys, from a worldwide currency economic, kind of index, we got the currencies themselves are doing great. If it wasn't for the Swiss franc slugging away in the cellar in the basement there, the currencies would be looking damn good. But you have to factor it in when you're talking worldwide economic, heat gauges or speed gauges, I call them. The surprise index. Okay, so looking pretty good. So let's take a look at some of these alerts. And it looks like I've had some, So I've had some alerts that have gotten triggered. So let's take a look. So obviously there's the Aussie dollar position that I'm in. So we'll just ignore that because we've already kind of beat it up quite well. We had silver hit. So silver hit some demand zones. So did gold, by the way, but I am not trying to step out in front of gold or silver right now because obviously you had the big gigantic drops. Look at this, guys. Look at the range we had on Friday. This is just the range. So the range from high to low was 38%. 38%. Okay, what about open to close? Okay, it's not going to look as bad when we're looking open to close. Open up here, close down here. So it closed 27% lower than what it opened. That's a quarter of the market. Good gone. Can you believe that? Is that not the craziest stat you've ever heard? 1/4 of the value of silver from open to close vanished. Okay, vanished. Probably a lot of profit taking. Okay, we already saw the COT report. Turn my heater on down underneath me. So we already saw the COT report where the big banks sold off around 2%. Was it 2%? I think it was 2%. I think that was 2%. Let's go have a look again. Silver. Yeah, 2%. So 2%. Anyway, it's crazy. Now, we did drop into some demand zones. We dropped into this daily zone over here. Okay, we had a daily zone here, but it had already been touched. But underneath it, I had put in a 4-hour demand zone. That's going to be this, this candle down here. So it looked like we dropped into that. And as you can see, let me go to a 4-hour chart. Okay, so there's my 4-hour demand zone that I had drawn up. And look at that. It just dropped in and beautifully bounced. Same thing with gold, I might add. It hit a similar demand zone. So picture this demand zone. And now look at the same thing on gold. On gold, now it's chewed through it, but on gold, it had actually bounced into a similar 4-hour demand zone before bouncing up. That still is just too, you got to have big balls to be stepping out in front of this. Now, I want to buy gold or silver, but I don't have an economic or a sentiment reason to buy it because it's not on my top setups. Okay, gold and silver, if I flip over to just specifically my neutral items, gold is at a +4. So remember, it's got to be a +5 or higher to be bullish. And then silver is all the way down here neutral at +1. Can I get a heat check? You guys got it? You guys in the chat, do you have any specific assets you'd like me to look at? Because I got a lot of alerts because a lot of currency pairs are on here. But if you guys have anything you'd like me to bump to the top of the list, please let me know. We'd love to know. We'd love to know. In fact, I'm going to put in let's see here. Very simple poll, guys. Is gold? Oh, come on. Is gold, silver going up? Oh, hold on a second. Oh, up this week or down? Oh my gosh, I can't get anything right over here. Now, hold on a second. Give me 1 second. Oh my gosh. Anyway. Answer that for me. I'm trying to do the poll question, but I couldn't figure it out. Pound dollar, yeah, I can look at that. Absolutely, Zambez IMEC. Let's take a look at pound dollar. So number one, pound dollar is a bullish signal. Okay, it is doing well from a fundamental and sentiment perspective. Here it is, pound dollar. It's giving me a bullish +5. Now, it's got a few items going against it. So now that we're in February, just like I said at the outset of the show, February is not a good friend of pound dollar from a seasonality perspective. If we look at an average of the last 10 years for the month of February for the pound dollar, this asset typically goes down. So this is one item against our bullish narrative. The GDP report, okay, that was a pretty good report that favored the US dollar over the last release. So that's another bearish reason. The PPI report favored the dollar more so than the pound. So that's going against our narrative. The unemployment rate favored the dollar over the British pound. So that's going against our narrative. But that's 4 boxes. What do we have going in our favor? Well, we got most of the jobs numbers. Okay, the unemployment claims, the ADP number, which, by the way, we have coming out. The ADP, the JOLTS number is what we have coming out here in a little bit. And then the non-farm payroll. Non-farm payroll comes out on Friday. Keep that in mind, everybody. This is an account killer. I'm telling you, non-farm payroll on Friday. You want to be sitting on your hands. Take your mouse and put it behind your computer so that you cannot hit the buy button or the sell button. And it's going to be the popcorn trade of the day. Okay, when non-farm payroll comes out, you get you a bowl of popcorn, throw it in the microwave, pop it up. You sit and you put your favorite chart on a 1-minute time frame. My favorite is dollar yen because it's the highest ATR, US dollar pair, and you just watch the shit show. Okay. So anyway, that's coming up Friday. That's also favoring though our pound. The CPI, the consumer confidence, the manufacturing PMI, and the trend are all favoring our bullish narrative. So I would say this is a bullish narrative, a bullish thing for the currency. But it's not like it's as strong as some of these currency pairs up here where we got 10s and 11s. Okay, these are a lot stronger. Ooh, Aussie dollar or Aussie Swiss and New Zealand Swiss actually got a little weaker because this was at a 13 when we started the show. Let me refresh my screen here real quick, and then we'll go look at the chart on pound dollar for you. Yeah, let's get this refreshed. Okay, so yeah, that's true. So yeah, +5. So let's go look at pound dollar because I was watching this last night. I was actually thinking about buying it, but I personally ultimately decided to buy the Aussie dollar instead. Pound dollar, though, if you're a fib retrace trader, okay, 38.2 was hit. But you guys know I don't look for fib retracements. I only use that as a potential odds enhancer. My whole reason to buy a trade is because of a supply or demand zone. Buy or sell, I should say. We did have a 4-hour demand zone here, but the price just kind of chewed through. This is a 4-hour chart. Let's step down to a 1 hour. Okay. So we chewed through that 4-hour demand, which makes sense to me because it's high on the curve. Let's get rid of the fib for a second, guys. If I'm looking at swing low and if I'm looking at curve analysis, let's go back to our daily. Okay. So our daily swing low is down here. Our daily swing high is all the way up here. See, pivot points. So if I'm looking at curve analysis, we're up pretty high on the curve, are we not? This top quadrant. Now we're kind of down into the middle quadrant. So basically the red background between this green line and this red line, that's the middle. That's diddle in the middle. This is chop territory, guys, higher time frame. The whole point of this chart is I want to buy low and sell high, right? So if I'm looking on a daily chart, which is where the banks are looking, where do they want to be buying? Typically, okay? Traditionally, they want to be buying down here. They want to be buying in the bottom third quadrant. And you guys see I've got a daily demand zone drawn up. So ultimately for me, this yellow candle is my path for pound dollar if I'm trying to get into this trade. Now, if you want to be aggressive and trade on a smaller time frame, knowing that the odds are stacked, not in your favor like they are on these higher time frames, then we could obviously drop down to some smaller time frames and find a new curve. Okay, there's a 4-hour. Let's go to a 1 hour. What's our curve analysis look like here? Okay, well, it depends if you want to use this as your swing low here or if you want to use this as your swing low. If you use this as your swing low, as you can see, we've chewed through it, right? So let's just say you want to make this your swing low over here because you obviously had a big run up. Actually, let's do this. Let's see here. Yeah, see, this is kind of a weird area right here. You didn't really get a dramatic drop and then bounce. It just kind of, you had a big spike up and then just a very lazy sideways movement for 2 days. So yes, this is kind of your swing low, I guess you could say. So your curve analysis would look like this. We'd look at that red candle there. And there would be your new curve analysis if we're just looking at it on this smaller time frame. Let's go down to a 1 hour. And as you see, we're clearly at the bottom. Okay? You got the top third, the middle third, the bottom third, which ends right here. So we're literally at the bottom of the quadrant. So if you're feeling frisky and if you're feeling aggressive, you're in a 1 hour demand zone right now. See this green candle and then the spike up? Now, I wouldn't want to buy there because when it moved up, it kind of died off and went sideways. See this price action over here? It just kind of went sideways. If I'm buying from this demand zone, I want to see price action like this, where it just keeps going. Right? That's a strong move. And as you see, we did have a 1 hour demand zone here inside of this 4 hour. So I've got confluence. This white line is the proximal line of the 1 hour demand zone. What happened though? We chewed through it, did we not? So we got the initial bounce off, from here, and then it pushed us up. But what happened? There's a supply zone probably buried in here on a 30-minute or a 15-minute that caught price and pushed it back down. So it basically, took away this potential buying opportunity right here. Excuse me, which makes sense, guys, because this is a bullish asset. Or I'm sorry, this is kind of it's high on the curve is what I meant to say. See this right here? That supply zone? You got a new supply zone right here. You got to keep an eye out on all these time frame supply zones. If you bought this demand zone here, okay, it pushed up, it got lazy, it actually bounced into the 4-hour just below it again and pushed up. But this time it caught this 15-minute supply zone. Okay. People came in and started short the market, pushed it back down. Now, if you were quick about it, this trade actually won this 1-hour demand zone. So remember, it's this green candle right here. That green candle right there. And then you had a big expanded range move up. You broke a structure with volume increasing. So that was a good idea for a 1-hour demand zone. You had this leg in, and then the one candle of base, and then the leg out. Now let's measure, because did that actually, and we'll just say that, you know, and if you're putting in a stop loss, well, actually, let's do this. We're going to measure just the candle itself. So this is your range on your 1-hour candle. Now, when price came in, you can see it did wick through it, but then it turned around and pushed. So did that give us a 2-to-1 or a 3-to-1? I'm just measuring real quick. 13. Okay, so 28, almost 29 pips. So it got you close to a 2-to-1, assuming you sold at the top, but, you know, nobody catches the tops. But then you kind of have this fanning out action now. Okay, I'm going to go ahead and delete that. You kind of have a little bit of a master pattern playing out in real time, or megaphone pattern, guys. Remember, we got megaphones. What is a megaphone pattern? I'll show you. See how we have a higher high here and a higher high there? But yet on the opposite end, we got a low, we got a little bit lower of a low, and then we got a new lower low. So higher highs and lower lows. I want to be taking this little disjoint channel button and connect these highs, the higher highs, and bring this down and connect the lows. And now what I've got is fanning out action. I love seeing this price action, especially when it's above a demand zone or below a supply zone, because that's basically manipulation from the banks putting, you know, they're making it to where there's stop losses being put above all these swing highs and these swing lows, so that they can ultimately position for a much larger trade on their end, which for me, I would see a potential place to buy pound dollar. Number one, the bottom, but possibly even this one hiding in here. So I have an alert at 1.3539 on pound dollar. And again, if you're a fib trader, well, there you go. It's going to basically put you, you know, under 61.8, but around the 75% level. Okay. It's a little deeper. I like deep retracements. I ultimately like retracements all the way to the origin of the strong move up, which is down here. But the most important thing is for this one down here is demand zone. We had a gap right here. So there's our fair value gap showing strength. Fair value gaps prove the strength of the supplier demand zone on the other side of it. Same thing if we were to take a stab at this higher one. Now, I don't think this is a higher probability because there's an inefficiency below. Banks tackle inefficiencies all the way through to the origins of overall strong moves. So I would see that they would want to close or, you know, close the gap, fill the gap, right? And collect the unfilled orders and the liquidity on the other end to fuel their overall move up. So, but they could potentially do it here as well. Okay. So if I'm a bank, because remember, we want to think like a bank. We don't want to think like a retail trader. But if I'm a bank, I want to do this fanning out action because I already know there's stop losses over here. Okay, there's going to be stop losses right here. There's going to be liquidity right here. Well, why did I make that red, Tiger? Shouldn't you make that yellow, green? No, these are stop orders. These traders that bought the market here and pushed price up, they had to put their stop losses underneath. The opposite of a buy is a sell. So that's sell orders. There's a stash of sell orders under here right now from these buyers that pushed price up. But if I'm a bank, I want to start manipulating price here so I can get liquidity on both sides. Okay, I want to get liquid. Oh, come on now. Oh, good grief. This thing is so touchy, guys. I use the magnet tool, so every time I get too close, it sucks in everything. But anyway, there's going to be more sell orders here because of these traders here that are buying. Up here on the top side, there's going to be the opposite. There's short sellers that are trying to push price down. Shorts, they're going to put their stop losses up here, which are buy orders, right? So if I'm a bank, I'm going to be manipulating price to kind of accumulate a position. And who knows how far out this fans, right? We don't know. We don't know how far out this fans. But ultimately, I'd like to see it fan out something like that so that we get a final, we basically get a push like this. Liquidity, 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 and then a final push down to collect liquidity. And oh, by the way, hit some unfilled orders. And then ultimately take our long position like this. I'd be wanting to buy here or buy here if this one fails. But you basically just get manipulation on both sides of this trend line, right? Hopefully that makes some sense. It's a little more advanced, I got to be honest. Sometimes I get carried away. But the idea for me on pound dollar, if I was not in an Aussie dollar long like I am, I'd be wanting to buy in one of those two demand zones down here. Because this is where the banks are playing. They're playing on these higher time frames. Okay, this is a 4-hour time frame. So daily 4-hour. That's my spot. That's my bread and butter. That's where I personally have my edge. Now, my edge may not, everybody has their own favorite time frames. But me, I perform my best when I'm trading from the 4-hour and the daily time frame like that for supply and demand zones. Now, I'll still go down to a 1 hour or even a 15-minute at times just to fine tune my entry. But all my buying and selling decision starts with a daily demand zone and then drop into a 4-hour demand zone and trying to find a 4-hour demand zone inside of the daily like I have here. That's confluence. And then you see a white line. That's a 1 hour even within. Okay, so that's 3 time frame confluences. I want to see as many sets of eyes that understand supply and demand on a price point, as many as possible, to place my buy or sell decision. Not retail eyes either. I'm talking about smart money eyes. Banks, institutions, prop traders within institutions that are looking at smaller time frames. Okay, I want to see the smart money eyes on the same price point. And that's why I put a zone around it. Okay, because unlike a support and resistance line, guys, support and resistance, you have to be exact. Supply and demand zones, you don't. There's a big difference between a support and resistance line and a supply and demand zone. You'll hear people say it's the same thing. That's bullshit. It's not the same thing. A support and resistance line represents a spot on a chart where price has returned to multiple times, right? A supply and demand zone represents a push away from an institutionally created consolidation. They push price away in a strong manner. And then when price returns to that zone, the idea is there's unfilled orders there that the banks need to fuel their higher, their much larger positions. So I only want to touch a point one time. When a price goes to a supplier demand zone, I buy it one time. When price leaves and then comes back a second time, think about it. There's no unfilled orders left because the bank sucked them up on the first retracement. So unlike support and resistance, we touch a supplier demand zone. We make a buying or selling decision from a supplier demand zone one time. And that's it. That's it. Support and resistance, though, the more times price hits that particular price point, in theory, people say it makes it stronger, right? And it does for a retail crowd. But if you want to make retail crowd money, follow the retail traders. If you want to make big bank type money, the people that are making money every day in this market, follow the institutional footprint, the institutional supply and demand zones. That's where it's at. Okay. And where do they like to hang out? Higher time frames. Longer term positioning, short term positioning, long-term swing trading, okay, short-term swing trading for the prop traders of the banks and institutions. And they're looking for, like I said, 4 hour at minimum, guys. 4 hour minimum. 4 hour daily. That's where the bread and butter's at for me. So anyway, pound dollar, that's kind of a long-winded way of answering your question, but yeah, that's where that's the only place I'd be excited about. I'm not personally that excited because I've already got my risk on a US based asset, and that's the Aussie dollar. I don't like doubling up my risk on any one currency. So I've already got a position on this US dollar pair. But if I were not in the Aussie dollar pair, this is what I'd be looking at. Number one, I'm going to put in a small position here if and when I get a kind of a break of structure to the upside after it hits this demand zone here, because that is a strong gap. You can't deny that. Okay, volume spread analysis picked up showing institutional interest. What I think is institutional interest. And if I take a small loss right here, then I'm not worried about it at all because I got an even better chance down here on this move at the origin of this strong move up. That is the closest imbalance, this fair value gap. That is the closest imbalance to this origin of this strong move up. Down here, I'm not worried about because all these wicks, all these candles here, they overlap the candles and the wicks to the right or to the left. That represents efficient price action. If it's efficient, the banks have no reason to tackle it because there's not any unfilled orders beyond it. The banks love to close gaps, as you guys know. That is one thing that everybody says, okay, in trading and on YouTube. Gaps like to be closed, and that is true. But gaps like to be closed because there's typically unfilled orders on the other side of it that banks can utilize in order to fuel their overall moves the opposite direction. So, yeah, that's a little bit of a breakdown. Hope that makes sense. Yeah, we still got, let's go take a look, guys, at our report that came out. I'm going to have to start setting alerts on these things. Oh, never mind. I'm sorry, guys. 9 a.m. Yeah. So I'll be off the stream by then. But just keep in mind here in an hour and 8 minutes is the manufacturing sector release for the Purchasing Managers Index reports. Again, the U.S. dollar is in contractionary territory with this number because we are under the 50 baseline, but they are projected to increase by 0.6. So from 47.9 to 48.5. While that would still be contractionary, that is a short-term bullish look if that doesn't happen. If it hits 48.5, well, then it was expected. But if it's anything over 48.5, so 48, 48.6, 48.7, then that's obviously going to print this in a green font. If this thing grows, if this goes into the expansionary territory, like if it goes from 47.9 and it skips the forecast and just goes straight into 50, well, that's a good sign because it would go from contractionary to expansionary. So you could potentially see the dollar get, a pretty decently strong score. Now, selfishly for me, I want to see it bearish because I'm in my Aussie dollar long position. Right? So it's just kind of, it's just entertaining. And I don't want to say entertaining. It's interesting to see, what you need and want to have happen in order to make your trade work. Now, I don't want to see the economy of the United States just, start sucking. For that reason, I want this report, to go in the favor of what our pocketbooks are doing. But selfishly for my trade, yeah, I want to see the dollar go down, which means the Aussie goes up. But we'll see what happens. Looks like we are retracing a little bit of the profit, the unrealized profit down here. Okay, it's just unrealized at this point. But as far as the rest of the day, because I'm in Aussie dollar, my goal is to just stay away from Aussie dollar and US dollar based pairs and just go straight to some of these other very bullish assets like the Kiwi Swiss. And wow, I guess that'd be the main one. Kiwi Swiss, New Zealand yen. Yeah, I'll go look at that. So let's just take a quick look at that, guys. Actually, guys, did we go over gold? That's not it. Yeah, I think we did kind of go over gold already, guys. Just remember, you might let things shake itself out. We did have a gigantic drop, obviously profit taking and things of that nature. Some of these geopolitical events as well. We chewed right through that demand zone. So this is the demand zone that I drew up because it also intersected with this swing high over here. Markets didn't care. It just chewed right through it. Now it ended up catching a bid off of a 1 hour demand zone and bouncing to the upside. We basically caught the bid from, let's see here, down here, right here. So this is where we caught the bid. I do believe it was. Let's just go put a line here. I think that's where it was at. Yeah. Okay. So we caught a bid there to push price up. Now, in order for me to get involved in gold or silver, guys, I need to start seeing a new series of higher highs and higher lows. Where do I feel the most comfortable doing that on? Probably on a 4 hour time frame. I really want to see this week if we could start changing that around, because otherwise this thing could go sideways. Gold and silver could very easily go sideways this week, because you've got, think about it. You go from last week, you go from I guess the first 3 days of the week were up, and then the last two, Thursday, Friday, were down. Obviously, Friday was down, but you're going to get a lot of uncertainty in here. My nose is itching. So it wouldn't surprise me at all if this thing just goes sideways for a few days or a week. Ultimately, though, I do think that prices could go right back up. Now, it may not be right away for prices to get to these all-time highs on gold and silver. Okay, I feel like there's a lot of people like, what the hell do I do? But at some point, I really want to, or if I'm going to get involved in it, I need to start seeing this, this series of higher highs and higher lows again. Higher highs and higher lows over here. Because everything on a 4 hour or lower chart is screaming bearish. But you got to keep this in mind, guys. Does that mean this is a bearish asset? You tell me. When in doubt, zoom out. Get rid of the drawings. Is that an uptrend or a downtrend? That's a weekly chart. Look at the monthly chart. It is still higher highs and higher lows. Especially, you go to the month. You can go to the month on silver or gold. This is what you're going to see on every single candle from, somewhere in this area upwards. Higher highs and higher lows. See the opens and the closes of the candles? Every single one of these are higher highs and higher lows. Now, we're just brand new into February. So, currently we are down. This is your monthly candle. This is your February candle, which just basically means just today's trading action, plus Sundays for those of you guys here in the Americas, okay, where we're behind everybody. When would I think this would be bearish? When you start breaking last month's low point or the yearly. It actually coincides with the year as well. That red line. Okay. You start breaking that monthly low, then that's when you can start worrying or thinking that we might go into, some downtrend. Because remember, gold and silver have a history of spiking really hard and then just dropping and going sideways forever. Okay, like you had back here in the 90s. Big spike up in the early 80s. Zoom in a little bit. This is our monthly chart. Okay. Big spike up at the end of the 70s, start of the 80s. And then we had a big drop down and went sideways forever and a day. And then the same thing happened for the Great Recession. Okay, big gigantic spike up. Uncertainty. Remember, gold and silver thrive off chaos, and that's what we got, obviously, for the Great Recession. Big spike up, but then a big drop after things kind of balanced out, and then it went sideways forever. So where are we at now? Well, we're back into a big spike up over the last 12 months. Does this mean that we follow history? Remember, history doesn't always repeat, but it rhymes. So we could very easily, higher time frame, get this spike up we got, and then go back down and then start going sideways. Very easily could. Okay. Now, I'm not saying it's going to look like that, but that's what we've seen the last 3 times that we just looked at. Okay, the super high inflation we had back at the end of the 70s, which was basically the Jimmy Carter administration, and then the early part of Ronald Reagan administration, whenever they had to kind of get things fixed. Paul Volcker, okay, Fed chair, jack up, fighting inflation, jacking up the rates. Rates were up at, what was it, like back in, I don't know, 15, 20%, something like that. some ridiculous number. But they had to fight it, guys. They had to fight inflation. So, yeah, and as during that time, you had gold and silver spike. Gold and silver obviously spiking hard again. Okay. Russia-Ukraine war continuance, volatility from the Trump administration, tariffs, Greenland. Okay, all these geopolitical events that have caused it to go up. And then just wild speculation on the part of retail traders. So now we've got a little bit of clarity. We've got a new Fed chair. So that creates a little more certainty. Obviously, there's been a lot of wars that have been settled. We're still waiting on Russia, Ukraine. So that's some stability from those aspects. But again, you got to throw in the U.S.-Iran tensions, okay? And obviously seeing if there's any fallout from that Arctic framework that they did come up with for Greenland. So we still got a lot of geopolitical events that could potentially be burning some things up. We don't know that. But what we do know is our trend is our friend until the bend at the end. And as long as we're following the fundamentals and the sentiment and coming up with a trifecta of 3 different analysis groups, the 3 that make sense, okay? Fundamental, sentiment, technical analysis. In that order. Fundamentals are the most important thing. The reactions to these report releases, the red folder events, the high impact. That's your fundamental analysis. Your sentiment analysis, which is not talked about anywhere on YouTube. What are the big banks doing, and what is the average Joe and Jill trader doing? So we can do the opposite of Joe and Jill and follow the banks. And then the technicals are the least important thing in analysis and trading. That's simply where we go time the trade after our boss, which is a combination of the fundamentals and the sentiment, tells us where it's going. Okay? That's it. So anyway, guys, it is the end of the session. Well, tomorrow I'll let you know how my Aussie dollar trade's shaping up, or if I'm out of it, or whatever the case is. But just be aware, guys, to finish out for the day. Okay, just remember, we do have the 9 a.m. USD PMI data coming up. But tonight is the big ticket in the land down under. That's the cash rate for the Aussie dollar, which is projected to increase their rate by 25 basis points from 3.6 to 3.85. And then we'll hear their lip flapping session thereafter. Okay, so have a wonderful, lovely day. I'll be back the same time tomorrow at Trade Like a Tiger. Okay. Remember, I do put out a shorts video later in the day on all my socials. My link tree is on there as well. If you guys can go over here and follow it. Let me get it pulled up real quick. Just remember, my link tree is right here. If you click that right there, that link tree, that'll show you all my social sites I have. And if you guys like a specific social site, YouTube, Facebook, Instagram, X, TikTok, just know that I put a shorts video on there every single day. So definitely go like, share, subscribe, all that fun stuff. But obviously, guys, most important thing, subscribe here to the channel if you haven't already, because I do these lives every single day. So I'd love to start growing this channel here and helping even more people give back from all the hard stuff I've learned in 12 years of trading, guys. Can't believe it's been that long. So anyway, peace and love. I'll talk to you guys tomorrow.